Treasury stock is stock that has previously been issued, but a company has purchased back its own stock. We're going to be using the cost method to do this. So when we buy our own stock back, we are simply going to record it for what it cost us, what we paid for it. So let's say that we decide to purchase back some of our own stock, and we purchase, let's say, 1,000 shares. Let's say that it is $5 par common stock that we're repurchasing. And let's assume that we buy it back at a market price of $20 a share. All right, we're going to use the cost method, so whatever it cost me, that's how we record it. Remember, treasury stock is a contra equity. We're purchasing back our own ownership. We can't really, a company is owned by shareholders, so you can't own yourself. So this is a deduction in stockholders' equity. It's a contra equity. But when we purchase it, okay, we're going to use an account called treasury stock. That is the contra equity account. So we have treasury stock, and we're going to record it at cost. So we have $20 that we paid for it, and that was for 1,000 shares. So we're going to record this at $20,000. The par doesn't really matter here because we're using cost method. So whatever it cost me, that's what we're recording it at. If we paid cash for it, we're going to credit cash for the $20,000. And that's the purchase of the treasury stock. Now, you can purchase treasury stock. You can also sell treasury stock back in the market. So let's assume that these 1,000 shares, we hold them for a little while, but we decide that we're going to sell them back in the market. So let's say we sell 500 of these shares in the market. So we're going to sell, of those we just bought, we're going to sell 500 of those shares of treasury stock. And let's say that we sell them at $25 a piece. Okay? So, and we sell them for cash. So we're going to get cash, 500 shares, $25 a piece. We're going to get $12,500 in cash for that. So we debit or increase cash. Now, we sold treasury stock. So we're going to decrease that treasury stock account. So we're going to credit it. But we have to be careful. We're doing cost method for this. We recorded it at what it cost me. So we increase that account for the cost of it. So when I sell it, I have to decrease the account for the cost basis. Well, I bought it at $20 a share. So that's what I'm going to have to take back out of the treasury stock account. So 500 shares at our cost of $20 would be $10,000. So we're going to decrease or credit that account for $10,000. Well, we've got a difference here. I need $2,500 credit. Well, it's kind of like I sold it for more than I bought, and I did. I sold it for more than I paid for it, more than my cost in it. So that's a good thing for us. And since this is equity, this is going to be additional paid-in capital because someone has repurchased now stock in my company. So I have additional paid-in capital from the sale. So we have another paid-in capital account. Paid-in capital from sale of treasury stock. If you can read that scribble. Okay. That's where the $2,500 is going to go. So let's say that we decide we're going to sell some more of that original 1,000. We already sold 500. They're gone. We got 500 left. So let's say that we sell 300 of those that are remaining. So we sold 300 shares of that treasury stock at this time at 18. Let's say the market was down a little bit. So we can only sell it at 18. We sold it for cash. So we're going to get cash of $5,400. And again, it's because we sold treasury stock, but the treasury stock was recorded at cost, so I have to decrease it at the cost basis. We paid $20 for it. So 300 shares at $20 is $6,000. I need another debit to balance out my journal entry. And it's kind of like we sold it at a loss. Okay, well, as far as the cash goes, we got less cash for it than we paid for these 300 shares. So we're going to deduct it from the paid-in capital account that we associated with treasury stock. So that paid in capital from sale of treasury stock, a lot of abbreviations here, sorry guys, I don't have enough room, is going to be that $600 difference that I need. Again, the treasury stock, we know we're going to decrease it, credit it for the cost, the $20 times the 300 shares, or $6,000. That $600 difference, that $2 difference between the cost and what we've sold it back for, is going to go against the paid in capital from sale of treasury stock account. Now, there's an exception to that. You can decrease that account up until a point. You can only decrease it until it's zero. Okay? So let me give you a different circumstance. Let's say that back here, let's go back. Here's where we sold the 500 of those original 1,000 shares we had purchased in treasury stock. We sold them back, and we made $2,500 off the deal. Okay? So let's say instead of selling these 300 for 18, let's say that we sold those 300 shares at $10 a piece. Well, now I'm only going to get cash of $3,000. But the treasury stock, let me skip a little bit so we can talk about it. The treasury stock is still, again, it still cost me $20 a share for those 300, so we still need to decrease that account for the $6,000. Well, I've got $3,000 unaccounted for, okay? Well, we said we could take it against that paid in capital from sale of treasury stock account, and we can, but only until it goes to zero. Well, right now that account has a balance of $2,500. I can take $2,500 out of that account, but that's all I can take out of it. I can't make it go into a deficit side. We can't have a debit balance from it. So if you get to a situation where you sell treasury stock and you've exhausted all of that PIC account, that paid in capital account from sale of treasury stock, the rest will have to go directly against retained earnings, which is odd. We don't use that very often. But this is a special circumstance where you can. So the rest of the 500 will decrease directly against retained earnings.